Hi students, in this video we are going to talk about depreciation, and we are going to work on some problems that are related to depreciation methods. So we all know that every asset depreciates over its lifetime, whether it is your car or it is a machine in manufacturing company or any other asset or even a real estate property. Its values goes down, it deteriorates over its lifetime. So we need to calculate that depreciation. Why depreciation is very important in engineering economics? Because it has some tax implications. If you have a business and you have let's say you have a manufacturing plant and you have like 10 different machines in your plant, these machines depreciates over time, and you can take the benefit of this depreciation of your assets to get some tax benefits from government. For example, if you have income of let's say $10,000 and your depreciation for that year is let's say $2,000 based on the number of assets you have, then you can for tax purposes you can show your reduced income. You can actually subtract your depreciation from your actual income to get less taxes, in order to pay less taxes. So that is very important. So let's focus on this problem. I would like you to read the chapter from the book on depreciation in detail. It has lots of information. We are not going to cover so much information in this short video. I am exclusively going to focus on the problem, but I would advise you to go through the chapter in the book. Okay, so let's read this problem first. ABC Inc. is considering the purchase of a second-hand scanning microscope at a cost of $11,000 with an estimated salvage value of $1,000 and a projected useful life of 4 years. Determine the straight line sum of year digits and double declining balance depreciation schedules. Okay, so basically the company is planning to buy a microscope, right? Its initial cost is $11,000 and its salvage value is $1,000 and the useful life is 4 years. So basically what we can say is in 4 years the value of microscope is deteriorating from $11,000 to $1,000. So there is a total of $11,000 minus $1,000, $10,000 depreciation over the 4 years period, right? Now for the tax purposes, how much that depreciation should go to each of the 4 years out of the total $10,000 depreciation? What amount we should put in each year to get the tax benefits, right? So there are various approaches to calculate the annual depreciation. Different companies use different methods. So in this particular problem we are talking about 3 different methods: the straight line depreciation, sum of years digits swiped depreciation, and double declining balance depreciation. So by using each of these methods we will calculate the annual depreciation values, the schedules, depreciation schedules, right? So let's first focus on straight line depreciation. As the name suggests, it is one of the most straightforward. What we do is basically in this depreciation method we divide the total depreciation equally among all the years. So here the formula is D sub T, where D is the depreciation value, depreciation charge, T is the year. T can be 1, T can be 2, T can be 3, and T can be 4 depending on which year we are talking about. So D sub T is equal to B minus S divided by capital N, where B is the initial cost or the base cost of the asset, initial cost of the asset, that is B. S is salvage value and capital N is the useful life, right? So we can include those values here. B is 11,000. Microscope is costing the company $11,000 in the beginning. minus the salvage value, estimated salvage value of the asset or of the microscope. In this case is $1,000 at the end of its useful 4 years, right? So total, as I said before, total depreciation is 10,000, which is 11,000 minus 1,000. We divide that total depreciation equally among all the years. So we need to divide that by 4. So we have a $2,500 per year, the depreciation schedule with the straight line depreciation method. So that was simple. The next method is sum of years digits, SWIDE. I would recommend you to read this particular method in the book. Lots of details are given, but here we are going to briefly cover the calculations. There are two formulae that are important for calculating the depreciation schedules by this method. Again, DT is the depreciation schedule in the teeth year, right? Same as this, but the formula is changed now since our methodology changed. It's N minus T. T is the number of year for which we are calculating the depreciation charge. N minus T plus 1 divided by SWIDE. How to calculate SWIDE, that I am going to show you. That formula is there, but let's first focus on D sub T formula. N minus T plus 1 divided by SWIDE multiplied by capital B minus S, which is the base value, initial value minus salvage, right? In this case, N, the useful number of years is 4, minus T, that will be, we will vary that number for each year. So we will keep, for now we will keep it as T. Then minus 4 minus T plus 1 divided by SWIDE, which we need to calculate, and multiplied by B minus S, right? The formula for SWIDE is SWIDE, which is sum of years digits. It's calculated by this formula, N multiplied by N plus 1 divided by 2. And these formulae are given in the book, so you can read more about them there. But that's so simple. N is the total number of years, so that is 4. N plus 1, which is 4 plus 1 is 5, divided by 2, right? So 20 divided by 2, 10. So that's a SWIDE. So we can put that 10 in this formula here. Now we need to calculate the depreciation schedule for each year. It's not the straight line method, so the depreciation charges for each year will not be same, but the total calculation, if we sum all these numbers, they should add up to $10,000 total depreciation, right? So starting with year 1, we take this formula here. We replace the value of T as 1 because we are talking about year 1. So 4 minus 1 plus 1 divided by SWIDE, which is 10, right? Multiplied by 10,000, B minus S. 11,000 minus 1,000, 10,000, right? So if we calculate that, we get value 4,000. Similarly, we calculate for second year. Only thing that changes is T is equal to 2 now. So 3,000, 2,000 and 1,000 by changing the T values 3 and then 4. So you can see that we are getting the most depreciation charge in the first year, which is 4,000, and then depreciation values, depreciation charges for subsequent years are steadily reducing. If we add them, you will see that total is $10,000, right? So that's a sum of years digits method for you. Now the last method is double declining balance depreciation schedule. This is also very interesting. Again, in the book you will find a lot of information on this methodology, but in this video I am going to only talk about the formula that we need to solve this problem. So again, DT, depreciation charge, which we have been asked to calculate, that the formula is 2 divided by N. N we know, number of years. 2 divided by N multiplied by cost, which is initial cost, which is B, right, minus depreciation charges to date. That means, let's say we are doing calculation for third year. So D sub 3 will be 2 divided by 4, total number of years. Cost is $11,000 minus depreciation charges for first 2 years. The total depreciation charges for first 2 years, that will go here for the calculation of third year, right? Right now we don't know the total depreciation charges for the first 2 years also, so we have to calculate for each year. That formula is equivalent to D sub T equal to 2 by N multiplied by B cost minus summation of, this symbol is for summation of J is equal to 1, year 1 to year T minus 1. That means if we are calculating depreciation charge for third year, we are going to sum depreciation charges dj from year 1 to year 2, T minus 1, right, year 2 for first 2 years. So good, now we have the formula that we need. We can use that formula and calculate depreciation charges for each year. So starting with year 1, 2, we use this formula, 2 divided by 4, right? B value is 11,000, B value, minus the summation of depreciation charges. Since this is the beginning year, there are no depreciation charges in the previous until the previous year, which is 0th year. So that value is 0. 11,000 minus 0 is 11,000. That is, if we calculate that, that is $5,500. So that is the depreciation charge we are going to put in the first year, right? Sum of depreciation charges 5,500 plus previous sum of depreciation charges means we are calculating this term here in this column because we need that for subsequent years. So for the first row, sum of depreciation charges is same as the depreciation charge in the first year, because previous to that there are no depreciation charges that we had. So 5,500 to begin with. Then last column is for the book value. Book value is the basically the present value, which is this particular value, which is B minus the depreciation, the total depreciation until the previous year. So 11,000 total depreciation, basically not up to previous year, but basically book value is the cost minus depreciation charges. That's total summation of depreciation charges. So in this case, 11,000 minus 5,500. So at the end of year 1, the book value of the asset for the accounting purposes is 5,500. So that is clear, right? Now we need to do the calculations from second year. So in second year, again we can use this formula, 2 divided by 4. We are going to use 5,500, which is B minus depreciation, this value here, B minus depreciation, right, 5,500. If we calculate that, we get the depreciation for second year as 2,750, right? That and the summation of depreciation for the first 2 years, which is 5,500 plus 2,750 is $8,250. This is the total depreciation for first 2 years. Now to calculate the book value at the end of year, year 2, we can subtract 11,000. We can subtract the total depreciation for first 2 years, which is 8,250, from the initial cost 11,000, right? So at the end of second year, the asset has, in this case microscope, the book value for the accounting purposes is 2,750. That is this value there we are talking about. So that we can use that value for further calculation for year 3. 2 divided by 4. Only thing that changes is this value, which is the book value at at the end of the previous year, 2750, that we put here. The calculation for the third year, the depreciation charge for the third year is 1375, and then we add that value to this value to get the total depreciation charges for first 3 years. So that value is $9,625. We subtract $9,625 from 11,000, which is cost. We get the book value at the end of third year is 1,375. Now we use that value to calculate the depreciation for the fourth year, just like we did for the first 2 years, right? So we do that. We put 1,375 here, and we get the depreciation charge for the fourth year is 687.5. And we add that to sum of depreciation charges until the previous year to get the total depreciation 10,312.5, right? And the book value is 687.5 if we subtract the depreciation from the initial cost. But so that's the answer for the fourth year. But there is a problem here. The problem is, we know that the salvage value at the end of the year 4 is $1,000, right? And our book value is 687.5, so that's not matching. That means the book value cannot go below the declared salvage value. Government will not allow that, right? To go the book value below the salvage value of the equipment. So what we need to do is, we need to have this minimum $1,000 there. Here also the total depreciation sum should be $10,000, right? 11,000 minus 1,000, $10,000. We cannot depreciate more than that. So we have $312.50 more here. So that is not correct. We need to we cannot use this as a depreciation value. We cannot depreciate. We cannot use depreciation charge of 687 in the fourth year, even though the formula gives that value. What we need to do is, for the fourth year, we just use the total depreciation, which is 10,000 minus the depreciation and the total depreciation for first 3 years, which is minus 9625, right? That will give us a value of, I believe that gives value of $375, right? So that's for the final year. We will have a depreciation, not 375, I think. Yeah, that is correct, 375. So the depreciation charge for the fourth year is 375. If we add that to 9625, the depreciation for the total depreciation for first 3 years, that will give us $10,000, right? And finally, if we subtract 11,000 minus total depreciation for the 4 years, which is 10,000, we get the book value of 1,000, which is same as the salvage value of the equipment or the asset. So this is, we need that fixed for the fourth row. So that's basically your answer. We use 3 different depreciation techniques to calculate the annual depreciation charges, right? Again, I would advise you to read more about depreciation in your book. So with this, I end this video.